Hi, I'm Ryan Foley, a partner at Cunningham and Associates. Today, I am thrilled to be talking to you about ways that we can help your business make more and keep more. Cost segregation studies. This strategy directly impacts the real estate market. When you buy a building, if it's residential or commercial, you take that property and you depreciate it over a lifespan that's determined by the IRS. For residential, it's 27 and a half years. So you buy a building, you depreciate it over 27 and a half years. If it's commercial, it's 39 years. Now, the problem is that most individuals, when they buy a building, they A, have to take a significant amount of cash and put it down towards the purchase of that building. B, the building is generally not perfect. So they're gonna have to put a little bit of money into the upfit of that building. And C, they're borrowing from a bank or using their own capital. Well, let's assume borrowing from a bank, and no bank in their right mind, if you know any, let me know, are not gonna give loans for 39 years or 27 and a half years on an investment property. So what happens is the cash outlay is significantly higher than the deductions by the IRS. Fear not, there are strategies to go ahead and realign the cash outlay to the deductions. And not only that, done properly, the deductions can exceed what the cash outlays actually are. The way we do this is through a cost segregation study. And what we're able to do is take a building, whether it be residential or commercial, and break down that building from just a structural property to different parts, whether it be plumbing or electrical or lighting or HVAC or specialty fixtures, and it goes on and on and on. We can break down the building into different parts and then move those different parts into different asset categories. Now this is wonderful because those different asset categories we can now depreciate from 1 to 5 years. So the cash deduction on the tax return increases significantly. Here's some great examples. 24,000 square foot industrial building. They acquired the building for $875,000. We were able to create additional depreciation in the first year of $466,000 that had a net present value savings of $169,000. Now, what is net present value savings? One, it's additional depreciation. So we're pulling depreciation from 39 years, we're gonna pull that into the first year. So the back end to the front end. That's great because now we're saving money today. Based on the amount of money, the tax reduction today, that client received a net present value savings. $1 today is worth significantly more than $1 in 39 years. So you pull that money from 39 to 1, there's value to that because you can use that capital today as opposed to waiting on that deduction down the road. That investment available today is worth money. $466,000, $169,000 worth of permanent cash savings. Next example, a 10,200 square foot commercial building. The acquisition cost was $3 million. Depreciation on the first year, $661,000. Net present value, cash savings, $138,000. I love this one right here. A large apartment building. Acquisition, a little bit over $7.5 million. We were able to depreciate an additional $745,000, and this was a high income tax bracket individual. We were able to bring net present value savings of just under $300,000 for this particular client. I hope everyone enjoyed the information today and found it helpful, but I'm sure you have some additional questions. Click on the contact link and we can start the conversation how we can apply some of these great strategies to your business.